If you are buying real estate just for cash flow, then you are playing the game wrong. Most gurus will tell you just go after cash flow. But the reason that I was able to retire at the age of 31 wasn't due to the cash flow in real estate. It was instead due to ghost income, the invisible money that accumulates over time that made me a millionaire. Today, I'm going to show you 3 invisible paychecks that real estate gives you that the IRS doesn't want you to know about. And these 3 paychecks are what I call the 3 wealth multipliers. Let's start off with talking about the first wealth multiplier, which I'll show you on this wealth graph. The x-axis on this graph is time, and the y-axis is your wealth or real estate net worth. Now, the first wealth multiplier is called appreciation, which is the value of your house going up over time. It's represented by that green line that's going up like this. And it usually goes upwards at a pretty steady rate because real estate prices are pretty stable over time. Now, here's the really cool part about appreciation. In real estate investing, you use something called leverage, where you only put 20% down on the property. And what this essentially allows you to do is literally double or triple your money. Let me show you what I mean. Though you only put a 20% down payment on the property, you have 100% control over that property, which is 5 times the money that you put in. So when the price of the house goes up 7%, you don't just make a 7% return, you make 7% times 5, which is a 35% return. Let's go ahead and take a quick example. You can see on this graph that I'm using an example of buying a $300,000 property. Now, let's say I put 20% down on that $300,000 property. Well, that is $60,000. Now, let's say the property went up about 20% over the course of 3 years, which is about 7% a year, which is a pretty standard appreciation in a high demand market. So that means that our property went up $60,000, so it's now worth $360,000. Now, because we invested $60,000 to buy the property, when you divide the $60,000 gain by our $60,000 initial investment, you get 100% return. In other words, you doubled your money in just 3 years. And again, that's because we use leverage, where you put a small amount of your own money into the investment while the bank pays for the rest of it. And at a 7% appreciation per year, that means I double my money every 3 years. Real estate is the only investment where the bank actually allows you to gamble with their money and keep all of the winnings. Think about that for a second. Remember, the bank is putting down the 80% while you're only putting down the 20%. Okay, now let's go over the other 2 wealth multipliers. On this same graph, you see this red line going like this. Not everyone is familiar with this line, but if you're a real estate investor, you need to know this line. This is the second wealth multiplier, and I call it the principal paydown line. Basically, every single month, your tenant will pay down your loan until the loan balance goes down to 0. And this is money that goes to you as something called equity on the house. It's crazy that part of the tenant's paycheck goes straight towards paying down your mortgage. And it's all, of course, perfectly legal. Think of it like forced savings. The money goes into the property, so you own more and more of it every single day until you pay off the loan, and then you own the property free and clear. And then at that point, your cash flow jumps up dramatically because you no longer have to pay a mortgage payment. Think about leaving your properties to your children and they have no mortgage attached to them. That's how you create true generational wealth. Now go ahead and guess what this green shaded area is on the graph. If you guessed equity, then you're right. This is essentially how much your wealth grows over time when you add together the appreciation on the property to the equity that you get from the loan paydown. And this equity doesn't even include the best part of owning a rental, which is getting cash flow, which is what you get left over after you subtract out the rental expenses from the rental income. So how can you apply all of this knowledge in a practical way? Well, there's a concept called recycling your capital. Let me go ahead and explain. When I was buying my 4th property, I ran out of money. The lender told me I don't have enough to put a down payment on this property. However, what he told me next was a game changer for me. He said, Ryan, don't you own a couple other properties already? And I told him, yes, I own 3 other properties. And then he asked me, well, how long did you own them for? And I told him 3 years. He said, I bet you have equity built up on those properties already. Now, you can use something called a home equity line of credit, also known as a HELOC, to take out that equity as cash and then put that cash as a down payment on the next property. And that way, you can save your deal. Sure enough, it turns out I was able to get a $100,000 HELOC out of my first property to use it to buy that 4th rental. Now, most people might wait 5 years to buy even their second property. Well, I was able to use the Wealth Multiplier 1 and 2 in order to buy properties 4, 5, and 6 for myself without using a dime from my W-2 income. Instead, I used the equity from the property and recycled my capital. Okay, so those are the first 2 wealth multipliers. Let's go over the final wealth multiplier, which is taxes. I would assert that real estate allows you to pay $0 in taxes on your rental income if you do it right. And in some cases, for example, if you use something called the Airbnb loophole, or if you're a real estate professional, then you can actually pay very little taxes on your W-2 income as well. Now, achieving real estate professional status is a long topic and is best suited for a discussion between you and your CPA, because I'm not a financial advisor and this is not to be interpreted as financial advice. But let's focus instead on how you can pay $0 in taxes on your rental income. The biggest tax break that the IRS gives you is something called depreciation. Some people call it the phantom deduction. The IRS assumes that there's going to be wear and tear on your property, and thus the property will lose value over time. That's why they call it depreciation rather than appreciation, when in actuality, the value of the house goes up over time. What depreciation allows you to do is to deduct a certain amount in taxes every single year for wear and tear. In my case, usually I can take about $7,000 to $14,000 in depreciation per property every single year, which means that first $7,000 to $14,000 in rental profits I make on each of those properties, I don't have to pay taxes on. Now, the IRS is also very liberal on the other deductions that you get to take other than depreciation. For example, you can take deductions from your home insurance, your mortgage interest, and if you go to visit the property, you can deduct travel expenses. And travel expenses include your flight, your hotel, and 50% of your meals. So I took this trip to Ohio to visit my rentals, and you can see some of the pictures up here. I spent most of my time at my rentals and then talking to my realtors and taking out my contractors out to dinner. But I also had some downtime where I, for example, got to see the original house from the movie A Christmas Story. But the best part, the flight, the hotel, 50% of the meals were all tax deductible. Uncle Sam paid for it instead of me. Why is that? Because I spent the mornings checking in on my rentals, and consequently, the IRS paid for part of my vacation. Now, there are people who will use a strategy, for example, where they buy a property in Hawaii and they rent it out on Airbnb. And then maybe they go visit their rentals during the day, and then at nighttime, they relax on the great Hawaiian beaches. Now, a quick caveat, again, I'm not an attorney or a tax accountant, so none of this is to be interpreted as legal or financial advice. But I will tell you is that if the deduction is an ordinary and necessary business expense, then it most likely is going to be tax deductible. For example, you can't go to physically see your rentals in Hawaii if you don't pay for a plane ticket. And you can't manage a rental without paying for some sort of lodging. And of course, you have to eat meals while you're down there to survive. That's why most real estate investors are able to combine all of their deductions in order to pay $0 in taxes. And let's say they do have a profit, what a real estate investor can do is purchase another property and then use that property's depreciation and deductions to end up paying $0 in taxes again. When in actuality, they might be making multiple six figures in cash flow. Now, the most boring way real estate investors make their money is through cash flow, which is taking the rental income and subtracting out all of your expenses, including the mortgage payment, property taxes, and insurance. Even though cash flow is the most boring part of real estate, you still need to be able to pay your bills today. While ghost income is great for the money that you accumulate tomorrow, you need a strategy to maximize your cash flow right now. And the best way that I found to do this is to use the rent by the room student housing strategy. I break down how I turned a single family home into a cash flow machine in this video right here. So go ahead and click on the video and I'll see you in there.